Real estate market is a delicate balance between supply and demand. The effects of these two competing forces are always amplified, skewed by the economic environment, job markets, consumer confidence, mortgage interest rates, and more. As housing market news is focusing on the continuing increases of the mortgage interest rates, the actual effect of these increases is quite unexpected. Many market watchers and industry analysts projected that the growing mortgage interest rates will depress home values, that home prices will decline or even crash, similar to what we experienced back in 2008, 9, and 10. Over the last year and a half, mortgage interest rates grew at an unexpected rate. The rates more than doubled from around 3% at the beginning of 2022 to almost 7% by the end of July of this year. Monthly payment for a median Bay Area home, assuming 20% down payment, went from approximately $5,000 to $8,000. But after the initial shock in the second half of 2022, the home values recovered and resumed year-over-year growth here in the Bay Area, as well as in many other regions of the United States. What happened was that the sellers withdrew from the market, amplifying ever-present Bay Area shortage of housing to new highs. Just look at the data. In July, the number of homes available for sale in Santa Clara and San Mateo counties dropped by more than 42% compared to July of last year. And 2022 was already a low inventory year. Potential sellers are interest rate locked in their homes. It means that homeowners are staying in their homes even when moving to a new home is in their best interest. These owners will accept significant compromises in their lifestyle and living arrangements before they decide to put their home up for sale. An extra bedroom or a larger yard is suddenly less attractive when you factor in that you have to give up your 3% mortgage and get a new one at 6 or even 7%. Many will go through the inconvenience of remodeling while staying in their homes or rebuilding instead of selling and buying a new home. The homes that come to the market are what we call non-discretionary sales. These are home sellers that have to move for a job in another state, people who retire out of the area, getting married or divorced, or having a death in the family. The unprecedented drop in the number of homes on the market pushed the prices up again, regardless of the significant drop in the home affordability levels driven by the interest rate hikes. Home sale prices are steadily growing since the beginning of 2023. By the end of July, median home sale price increased by 4.5%, measured year over year. Median time on the market was only 10 days, compared to 17 days in July of last year. It means that half of the homes that came to the market in July sold in 10 days or less. It was still one of the fastest paces of sale on record. While many buyers were held back by the high interest rates, many still aggressively pursued the shrinking pool of available homes. Let me get on a tangent here. Even though the Fed rate hikes are getting a lot of publicity, they're only a secondary factor driving the mortgage interest rates. Mortgage interest rates are closely tied to the 10-year Treasury yields. Historically, the gap between the 10-year yields and the mortgage rates are hovering around 2%. But now, since the interest rate started the run-up a little over a year ago, the gap grew to 3%. The increased padding was triggered by the general economic uncertainty and by expectations of the impending recession. During the recessions, the interest rates are expected to decline, and the lenders are preparing for a wave of refinancing. They are factoring in expectations of the current loans being refinanced after only a short period of 3 to 5 years. So if you're buying a home and getting a mortgage today, be prepared to refinance when the mortgage markets will normalize. All data shows that the seller's market continues. July ended with only 1.5 months of inventory. But it is not all rosy and easy for the sellers. It is not enough to just pitch a sign in front of your home to get multiple offers. In order to get the best price, the home should be perfectly prepared, staged, fixed, upgraded, move-in ready, and more. It should look modern and attractive to a wide slate of buyers to generate a massive level of interest and produce a bidding war. Today's buyers are a demanding bunch, and will drive the sale price down and extract a discount at every opportunity. And you should not be surprised. As the home sale prices are growing and the interest rates rising, the buyers' monthly payments are ballooning. Many buyers increase their down payments to the max by emptying their cash reserves and investment accounts, just to keep monthly payments manageable. These buyers dig deep into their financial resources and should be convinced of the great value of the property they are buying. For the sellers, get your home ready for the market the best you can. Don't take shortcuts. Buyers are pickier than ever and will discriminate against homes that are not prepared, shown, and marketed at 100%. We have resources to help you prepare your home for sale, from designers and contractors all the way to helping you finance the project. And if you're a buyer, we can help you identify properties on and off the market that present the best value with minimal competition from other buyers. We will work closely with you and your lender to determine your comfortable price point, especially now when interest rates are changing rapidly. This is Michael Tallis with the Tallis team. With major developments happening daily, if not hourly, I will stay away from predicting the next housing market move. I will continue, however, to monitor and report on all the latest trends. If you found this video useful, support us by clicking on the like button, subscribe to the channel, and share this video with other people who may benefit from it. Till next time.